perspective in terms of, the returns which we are currently seeing, or the potential returns which are possible currently, what would be the other pros and cons for a person looking to invest in FMPs?
Good afternoon, Sumaira. So I think Sir has very nicely explained how FMPs actually work, and there are a lot of benefits to it. The number one is, Sumaira, because it's broadly a buy and hold strategy. So what happens is there is no active management during the period of holding, which reduces the costs as compared to any other debt fund, which is around the same maturity. So let's say, I think SBI has, in fact, FMP has recently closed, and it is about 1460 days. So, which is around 4 years period. So the expense ratio for this product would be much, much lower as compared to any other active debt fund around the same duration. That's the first one. Second, I think, is the predictability of returns, Sumaira. Bonds, because they are traded, they are able to capture and they respond more quickly to how interest rates in the economy move. And because we are in an uptrend in terms of interest rate cycles, that is one of the reasons, of course, the FMPs are being launched. And there is a certain amount of predictability based on the indicative, portfolio that is given out by the fund house. So they do not tell the constituents, but because of the matrix which is given, which defines the amount of credit risk which will be taken and the amount of interest rate risk, you get to know the indicative yields which are there, and that gives the investors a lot of predictability as to what will be their returns after that definitive time period. The third one, because it's a buy and hold strategy, the interest rate risk is to quite an extent negated, because it works on accrual model where they are holding the bonds till maturity and earning the interest on them. The fourth one, Sumaira, of course, is the tax efficiency of FMPs or any other debt product, actually vis-a-vis fixed deposits. And I think the most important one in FMPs is the discipline that it brings, because investors, if they know that I'm locking in my money for the next 1400 days or 1200 days, I think that brings in the discipline. On the flip side, I think only one concern would be there, which is, in fact, two, sorry. The number one would be that investors must be careful and check the matrix as to what is the indicative, because there is no surety on what portfolio will be made. There is an indicative, the matrix which is given, and based on that, they must check what is the credit rating or the profile which the fund house is choosing. That has to be the highest rated papers, because in the past we've seen some trouble in the FMPs as well in 2019-20. So I think that's one important thing which investors need to check. And the second one is that there is liquidity risk, as in they have to be sure while entering the product that it's get logged in. Although it's traded on the exchange, the liquidity is very low. So they must be very careful that if they're locking in their money, they can only get it after that specific time period.
Okay. Mr. Singh, one of the things with the FMPs is that a lot of people who are looking to invest in it thinking that it is a very safe product, right? But even the past, I mean, the most famous case of this, going wrong was when we saw that Z standstill, right? Because even then FMPs had to roll over their maturities because some papers came into question. What has been the trend in terms of how the portfolio quality has since changed? I mean, what are the lessons which have been learned, and what are the kind of papers that FMPs now invest in?
Yeah, so in the recent past, whatever FMPs have come in the market, and generally also, and from our fund house also, we are making the portfolio only on the state development loans, because there's enough kicker available on that, and as state development loans are very, very safe, we are not buying any credit as of now. But yes, a lot of lessons have been learned from the past. As Prableen was talking about 2019, there were some issues, and those were also more of liquidity issue than the credit issues. But yes, lessons learned, because the people who are putting in money, they look at these kind of funds as being very, very safe. Very, very, there will be no issue. As you see the SDLs, as you are showing on the screen, in July it was 7.40% was this thing. Even if we have created a portfolio of 7.40, and 20-25 basis point is the expense ratio. The net in the hands of the investor at the time of maturity would be 750. So we are not buying, we are not trying to give a kicker to the portfolio of 15, 20, 30 basis point by getting a credit paper. While saying so, I'm not saying that credits are not good. There are so many good credits available. But since people are putting it as a very, very safe instrument, so we have to create the portfolio accordingly. And as Prableen rightly said, that is the risk when we are saying when the fund house, what they are saying, they have to walk the talk. So that's everybody is doing. I mean, I don't say that we are doing, nobody else is doing. Everyone, whosoever is coming out with FMP, whatever is being talked about, the portfolio is made accordingly. So many lessons learned. So that's how this efficiency and perfection has come into the market.
Okay. Prableen, one of the things like Mr. DP Singh also mentioned is that, portfolio quality is now improved greatly, right? But if we talk about, what kind of FMP does, well, normally it's that 3-year FMP, right? Because you get the added benefit of indexation. If you can explain to our viewers how this indexation works, and therefore, what is the tax advantage that somebody would get vis-a-vis investing in, say, a bank FD?
Right, Sumaira. So because it's broadly the investors who are putting their money in FDs would move to a product like FMPs. Of course, the credit quality has improved over time. And the next benefit which they get here is of indexation. Indexation is nothing but, Sumaira, at the time of calculating your taxes, the index refers to, calculating the purchase price. So the purchase price is recalculated based on what has been the inflation in the economy. And indexation in mutual funds can be claimed, of course, for a holding period of 3 years. And these indexation rates are calculated on the basis of the cost inflation index, which is a number which is given out by the government every year. So let me explain this with the help of an example. Let's say in the financial year 2016 and 17, I made an investment of 10 lakh rupees. And let's assume 7% as the return which was earned on it. And I have redeemed the investments in 2021-22. So it's a overall starting from 16-17 to 2021-22. It is a 6-year period, and at 7% returns. We don't currently we are not looking at FDs are taxed every year. We just see what amount of returns we are getting. So the returns would be about 14 lakh to 1,050 rupees. Now, how is this taxed? Simply put, for an FD investor, this profit is 4 lakh 2,050 rupees, because 14 lakhs minus the 10 lakhs which was invested. And if a person is in 30% slab, he or she pays a tax of 1,20,000, simply because FDs are taxed at your marginal tax slab. If you are a 20% tax-paying investor, then also on the profit of this 4 lakh plus, you pay at 20%, you are paying a tax of about 80,000 rupees. What happens in case of debt mutual funds or FMPs is that we now recalculate our purchase price. So the cost inflation index number in 2021-22, which is 317, minus the number which was there in 2016-17, it's divided, and that was 264. So we get a multiple of 1.2. And this multiple, Sumaira, is multiplied by a 10 lakh investment. So 10 lakh now becomes 12 lakhs. That means that the government is giving me a leeway that, okay, till the time your investment in it is increasing in line with the inflation in the economy as set up by them based on this number, they are not taxing me. So my purchase price becomes 12 lakh, and only over and above this 12 lakh, whatever profit I have earned, now I pay a tax of 20%. That reduces my tax to 40,000 rupees. So in the first case, it's 1,20,000, 20% slab person, it is 80,000. And if in case we are using indexation, it comes down to 40,000. So the 7% return, Sumaira, effective for the person in the 30% slab finally works out to be 5.09%. For the person in the 20% slab works out to be about 5.7%. But for myself, if I'm putting in my money in the FMP, my post-tax returns are still 6.38%. So that's broadly how indexation can greatly help in reducing your taxation. And the higher the number of years we are able to use for the calculation, the lesser the tax that we pay.
Wow. Okay, we're going to take a very quick break. Our two guests are going to stay on with us. We have a lot more to talk about the fixed maturity plans, but all of that is up next. So do stay tuned in. Hi, welcome back. You're watching MF Corner, and we're talking about FMPs or fixed maturity plans and what is giving rise to their popularity these days. With us are our two guests, Mr. D.P. Singh, Deputy Managing Director and Chief Business Officer at SBI Mutual Fund, and Prableen Bajpai, founder at FinFix Research and Analytics. So before the break, we have spoken a bit about exactly what FMPs are, their pros and cons, and the kind of benefits that they enjoy. But probably there's another similar kind of debt product, which is called the target maturity funds, right? And I mean, I can imagine that because of the nomenclature, there is some scope for confusion. So if you can clarify what are the differences between FMP and this target maturity funds?
Right. So I'll call FMPs a subset of target maturity funds only, Sumaira. So target maturity funds, as the name denotes, it's got a target. So you know the time period for which you're investing, and it matures at that time period. And it's a passive strategy. So the fund, the product, basically, the scheme just tracks an index which is out there. And in a passive way, they are able to replicate the holdings of the underlying index. I'll give you an example here. Let's pick IDFC Gilt 2027 Index Fund. So here, the underlying index is the CRISIL Gilt 2027 Index, which means through the name only, one can understand that it's investing in government securities as reflected by Gilt, and the maturity is in 2027. Now, this particular product would mature on the 30th of June, 2027. Likewise, we have the SBI CPSE Bond Plus SDL September 2026 50/50 Index. Here, Sumaira, again, there is an underlying index, which is the Nifty CPSE Bond Plus SDL Index, which is tracked by this particular fund by SBI. So I think the main differences here as compared to an FMP are, number one, in case of a target maturity fund, you already know the underlying portfolio, because an index is going to be replicated just like an index fund in the equities. If I say that I'm going to invest in a Nifty 50 equity fund, you know that the underlying index are the Nifty holdings. Likewise, in the target maturity fund, you know the constituents. In case of an FMP, the portfolio is constructed later. So you have an indicative structure as to what sort of interest rate risk and credit risk will be taken, but the holdings are not known until the portfolio is constructed. The second difference, and the very important one, is that target maturity funds are open-ended. So you can buy, sell at any time, but FMPs are closed-ended. They're open for a limited time period, and then you cannot redeem your money till maturity. The third one is that FMPs are listed on the exchange. And of course, with target maturity funds, because there are ETFs or index funds, that is not required. And the fourth one is that FMPs usually are in the 1 to 4 year time period they are launched. And target maturity funds, interestingly, Sumaira, are for much longer. Till now, we've seen from, let's say, 3 years to 10-year period. But now, like IDFC has actually, filed for a product which is going to mature in 2062. So we'll have much longer duration, these target maturity products coming in the market. So these are the broader differences between the two.
Okay. Mr. Singh, I can imagine that the kind of investors opting for FMPs would be the one for whom the safety of capital is the primary goal. But what are the kind of financial objectives or say goals which an FMP is most suitable for?
No, FMPs are suitable for the people who know that they don't need this liquidity for next 3 years, 4 years, so that they tend to put money here in FMPs. And the basic difference between FMP and target maturity, what you were talking to Prableen, in the layman's language is the FMP is close-ended, that it will be matured at that time. You can take the liquidity only at that point of time. Whereas in target maturity, if you are withdrawing in between, I will compare this with the what you call modes or this liquid FDs which are being sold by the banks nowadays, that you can put the FD for 3 years and whenever you want to withdraw, you can withdraw, and for whatever period it will be running, you will get the interest. Against that, target maturity fund is for those people who know more or less they will not require it, but they want to have the liquidity option available with them, even if they have to sell it at a discount or see at a premium, because in case of FD, it will be only a discount. In case of target maturity, there is a probability if the interest rate goes down in the market, you may have the possibility of having a premium on the returns which you have already been you has been indicated because you know the portfolio. So that's another point. The people are same. The people who are very, very certain that they don't need any liquidity, they put in FMP. The people who they know that they have the money for 3-4 years, but there could be some uncertainty and they may need this money. And the typical FD investor, customer, they can put money in target maturity funds.
So, sir, is there any checklist an investor must sort of go through before they, choose between the many kind of FMPs on offer?
Basically, the portfolio quality as far as FMP is concerned, what is the portfolio quality, what is being indicated, whether it's going to be SDLs, whether it's going to be high-rated credit, AAA rated, so on and so forth, or it's a lower-rated investment grade paper also. So it depends upon the risk appetite of the investor. That is the first checklist which is there. Another point at this point of time when we are talking today, see there's the example which Prableen showed, that was for the previous years where the inflation rate was quite low and we go to a position where we were to pay 40,000 rupees tax. But as we are talking, the inflation itself is very high. Maybe after 3 years, if the higher inflation rate scenario continues, there could be a zero tax implication also, because the indexation will be high. That is one. But see, coming back to the checklist, I think in FMP, other than the this one, that what is going to be the portfolio quality, nothing. And as far as target maturity funds are concerned, there, as is told earlier, the maturity and paper is already known. We cannot go like if SBI is having CPSE bond and the SDL, then we cannot go out of this. The index is made of both these CPSE. There could be 5-10% here or there, that 50-50, I mean 50 could be 60 and the 40 could be, the 50 could be 60 or 40. That way it can happen, but overall the quality will remain the same. That is also, that's how it is.
All right, Mr. D.P. Singh, Prableen, thank you very much for joining in today to explain the concept of fixed maturity plans and, of course, the wider target maturity products as well. With that, we're going to wind up on MF Corner. I hope you found this informational to you as well, but do stay tuned in. The team of Closing Bell joins you next.